Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. The new year is an awesome time to reset. Diets, exercise, but what about top considerations for employers too? Well, you are in luck because today we are going to tackle some of the important issues like estate tax, tax planning, managing risk, and maybe some other important issues that are going to prepare your business to be valuable for sale, transition, and exit. I think these are really important topics that sometimes we don't give enough focus to. We like to kick them down the road. But you know what? It's January, so let's start strong. So I've got with me Mike Prinsno, and he is the managing principal of our Individual Tax Solutions Group. Welcome, Mike.
Thanks,
And
Leslie.
I've also got Lisa Horn, and she's a principal in our Owner Transition Services Group. So welcome to you.
Good afternoon.
All right, before we dive in today, we do have some housekeeping that we want to cover. We do have the ability for live Q&A during our session today. So in order to participate, you do need to register and log in using the link below me. And those questions are going to appear in the audience, and you have the ability to like those. And by doing that, that actually moves those up in priority so that we can best address those. We do have moderators that are standing by, and they are ready to engage and interact with you. We also do want to let you know of a couple special events that we have coming up. So the month of February, it is event month here. So first of all, on February 8th, we have an event on the R&D tax credit. There are a lot of developments happening in the R&D world, so be sure to check out that event. On February 17th, we have a session that will cover changes that are coming to employee benefit plan audits. And then finally, on February 23rd, we have a session on nonprofit lease implementation and best practices. So you can register for all of these events on our website. Finally, in addition to webinars and white papers, contact your CLA relationship because we absolutely want to talk with you. So with that, let's begin our session today. We'll get started with Mike and Lisa. And Mike, we'll start with you. In 2021, there was a ton of consideration given to how individuals and businesses were going to be impacted by potential legislation. Build Back Better was a big thing that was looming. What are your thoughts as we are getting into 2022 about potential tax legislation, and what types of conversations are you having with clients about that are in high tax brackets and what they should be thinking about?
Yeah, thanks, Leslie, and thanks for having me on today. Appreciate the opportunity to spend some time with you and Lisa and with the audience today. As we think about 2022, it's important to maybe frame that a little bit by reflecting back to that fourth quarter of 2021. During that time, as you know, we had the infrastructure bill that was enacted into law in the fourth quarter, and there was a lot of focus on Build Back Better, a piece of legislation that started out, and it was much broader and had significant implications for many. That legislation, as it worked its way through Congress, was pared back and was a much smaller bill, although still a very sizable piece of legislation. Well, that became a focal point for many of us that work with businesses and business owners as we were trying to read the tea leaves, so to speak, to take a look at what's the likelihood that certain provisions would come into law. And so it created an interesting dynamic and a situation for us that we had to essentially look at different scenarios. In fact, Leslie, I think you mentioned this last year on one of the live streams, really that idea of working with clients and using scenarios to highlight kind of what might happen. I think you coined the phrase extended. Encourage our clients to give some more time to see what might come of some of the legislation that was being discussed. Well, in that vein, we focused on Build Back Better and some of the provisions and looking at how that might impact some of our high net worth individuals, business owners, and some of the provisions that might be applicable. And with that, and looking at some of those scenarios, that kind of carried through into the first part of this year. Now we're in an election year, and the entire House of Representatives is up for election, as well as a third of the Senate. And so the likelihood at this point that we'll see Build Back Better in its form come to fruition is very, very low. It did not get out of the Senate. There's some discussion that pieces of that might be undertaken in separate bills. But for our audience today, a few thoughts on 2022. I think we go back to looking at that individual and helping to understand their situation and looking at, are they in a high income year? Are these some peak earning years, for example? If that's the case, then there's a lot of tried and true methods of looking at accelerating deductions, deferring income where that's possible, really to manage that overall tax burden. We can also look at things like qualified opportunity zone funds. That's something that we've talked about on live streams at length in the past, but certainly as a good planning technique when we have individuals that are facing large amounts of capital gain income. And then lastly, looking at, especially in weeks like this, where we see lots of volatility in the market, look at loss harvesting opportunities, because those capital losses, although painful because they reflect a decline in an investment, right? They can be utilized and harvested so that they can offset capital gain that might be coming later in the year. So those types of strategies are what we're discussing right now, given that we're, again, in this landscape where certainty around tax legislation this year is a bit unclear right now.
Well, I think those are all really good strategies. I do love your continued focus, and I think we all love it, on just giving yourself that breathing space, extending if you can, and really modeling and doing scenario planning, because I think it's a huge benefit, especially when there could be pending legislation and we just don't know. I do want to also just talk about, we work with so many individual clients. I think the number is almost 100,000 or more. And, we talk a lot of time about people's income going up, but that's not always the case. We do have a lot of people who might be retiring, and that happened a lot this past year. People exited the workforce during COVID, or we've just got a lot of boomers, and maybe they're leaving and they're exiting the workforce, so they could have a decline in income in the future. And I think there's tax planning strategies around that too. And so what are some of those?
Yeah, thanks for that question, Leslie, because you're right. That depending on that individual's unique situation, because it could be the exits that you talked about, it even could be that maybe it's a rebuilding year, and so income's going to taper off for a business owner, for example. Well, in those years, one of the things that's really important is that we look at, are there opportunities, given that we might have come down in the brackets associated with a certain level of income, and so we might look at opportunities to create some assets that could be utilized in the future. For example, in those lower income years, perhaps one could make a contribution to a Roth IRA. Now, that contribution is subject to limitations depending on one's income. But why that's valuable is because if you can think forward into the future around assets that might be necessary in retirement years, a Roth IRA creates for you the ability to harvest some of that asset, and it doesn't bring with it a tax consequence. So as individuals withdraw monies from a Roth IRA, it doesn't produce a tax consequence. So that creates some additional flexibility that can be very helpful and useful for someone in retirement. Along those same lines, if we're looking at a decline in income, sometimes it might make sense to take some traditional IRA contribution dollars and convert those dollars into a Roth IRA. Now, in that event and in that transaction, it creates taxable income. So that's something where that scenario planning becomes so important, because you don't want to make just a rash decision and convert all of an account, for example, because that could have significant tax implications and cause you to lose out on some other tax benefits or push you into the highest marginal rate bracket, if that makes sense. So those are a couple items that we would suggest in those lower income years. Again, that planning around those years when that happened is almost as vital as when we're talking about high income years and looking at strategies that are applicable at those times as well.
I think that's great advice. So, it's never a one size fits all strategy, is it?
That's exactly right. Yeah, and it could be fluid throughout the year, as we saw last year with different pieces of legislations coming to the forefront. Then the need for that dynamic approach was even more highlighted last year.
Yeah, I think that's right. Do we want to talk a little bit about business? Because I think business is where sometimes this can really start.
Yeah, I think that makes a lot of sense. And Leslie, maybe if we can turn the tables a little bit, and I can ask a question of you as you work with many business owners around the country, and as you have some of those discussions around same kind of topic, 2022, and what items should a business owner be considering? Lots of incentives that were part of these different pieces of legislation last year. What are some of those discussions that you're having with some of the businesses and business owners you work with?
Yeah, great question. Love the turnaround there of the question too. So, it's interesting as we get into planning this year, I think one thing that a lot of people overlook is the ability to keep tax planning open and to keep it flexible and fluid. And a lot of people say, well, how do you do that? Well, there's this really neat tool out there to do that called accounting method changes. And so especially with automatic accounting method changes, these are ways that you can do tax planning on 2021 while we're here in 2022. And you can pull the lever sometimes on deferring income or accelerating deductions on your 2021 return, even though that year's ended. And so that could be with things like depreciation, maybe you do a cost seg. It could also be, that you find a way to accelerate prepaid expenses. Maybe you pull the lever somehow on deferred revenue. You do an accrual to cash adjustment. It's really a whole host of how you're moving income and deductions and keeping tax planning flexible, which I think is super important when we're in this environment of dealing with uncertainty. We don't really know what's going to happen with Build Back Better, and it allows us to really pause and think and pull the lever in some unique ways. So I think that's definitely one thing that's out there. Another thing, Mike, that we talked about, and we did it right before year end around the holidays, was we talked about pass-through entity tax elections, or PET elections is what everybody's liking to call these things for short. And so a lot of taxpayers are aware that the Tax Cuts and Jobs Act instituted this $10,000 state tax limit for individuals, and quite a few states have responded to this $10,000 SALT cap deduction by really allowing pass-through entities to instead allow the option of calculating and paying that tax at the entity level. So there's all kinds of complexities. I mean, you really open up Pandora's box when you start to look at these as to, does the state allow it? If they allow it, are there credits and offsets then on my individual return for taxes that I pay to other states? What's the timing of the election? How much can I prepay? So you have to go through and really do a model and an analysis on a state-by-state basis. But it's definitely something that's worth exploring if you are a business owner and you live in a high-tax state. So that's another thing that we are seeing gain a lot of traction and interest with the clients that we serve. WOTC is another area, which is the work opportunity tax credit. So this is something that is out there for employers that are hiring people that are in certain designated categories. And we have so many people right now that are saying, I need workforce, right? It's a huge pain point for probably every single industry that we're serving right now. And so if we have people that are hiring in certain designated categories right now, and it's not net new job creation, it's just, are they hiring? That can be people that are in long-term unemployed categories. It can be hiring in hardship categories, so hiring people that are on SNAP benefits, TANF benefits, hiring in different veteran categories. It can be hiring people that just live in rural renewal communities or empowerment zones. That is a great way to individual that you hire that you keep employed for a certain period of time. So it's another great way to get cash for something you're already doing. And then I think we're seeing a lot of people ask about the employee retention credit. And, there was a lot of buzz around this, and would they keep that for Q4 of 2021? They did not keep it. It actually did get repealed for Q4 of 2021. However, what I will tell you is we are still seeing so many people that maybe overlooked this incentive and didn't take advantage of the ERC. So I still would tell people, go back, understand what your gross receipts declines were in 2020 compared to the relevant reference period in 2019, and the same for 2021. And understand, for 2020, did you have a 50% decline compared to that reference period in 2019? For 2020, was it 20, or for 2021, was it 20% or more compared to that reference period in 2019? And really evaluate, do I have an opportunity there? So those are just some great ways that I think to think about how you can keep some planning fresh for this year. And then the last item I'd touch on, Mike, that I think is really just important is, everybody's watching legislation, and because the legislation hasn't moved, what people are losing sight of is the fact that there's actually some changes that are coming in this year from the Tax Cuts and Jobs Act that people have lost track of. So there is this interest expense limit that many industries are familiar with. It's called the 163J limit. We're limited to the deductibility of interest expense for 30% of an adjusted EBITDA number. That calculation actually changes in 2022, where now it's modified for depreciation and amortization, and that can be a big deal if no action is taken on legislation. Similarly, R&D in the Tax Cuts and Jobs Act is changing, where normally R&D costs are currently deductible, but that's also something that's going to change, where absent any change to the legislation, R&D costs are going to have to be capitalized and amortized over a period of time. So things that people are watching, they could affect estimates starting in 2022. So things we definitely need to be aware of. But I think it's a great question, because I think the planning opportunities are just endless as we think about that.
Yeah, I think that makes a lot of sense, Leslie, in even thinking about kind of that first quarter impact, as we're working with a lot of businesses that may not have realized those couple changes that will impact some payments coming up here in April. So I appreciate you mentioning that.
Well, let's bring in Lisa to the party here. And Lisa, it is awesome to have you join us. We've talked a lot about businesses and their owners. You work a lot with business owner clients. And so as we think about business owner clients, tell us a little bit about how you personally have helped clients and how your team helps those clients to transition their business.
Well, Leslie, thanks for having me here today with you and Mike. And I'm really excited because we're almost at the end of January. And when we talk about resetting for the new year, what a great time to think about what is our plan for our business in the future. And so I'm part of our owner transition services team, and my role on the team is as an owner transition advisor. And we like to work closely with our business owners to make sure that they always have a plan in place to exit their business. And when we think about that, it would be great if we could all be, in charge of the outcomes, but that's not the reality all the time. So what we want to make sure is that we have removed all risks from the business. So on our owner transition services team, we have all the people, all the capabilities that are necessary for a business owner to have all the right steps in place for transitioning their business, whether it's a planned transition or not a planned transition. So go ahead, sorry.
Oh, no, that's great. So tell us a little bit more about that.
So the process that we like to do is whether it's myself or one of the other owner transition advisors, we meet with the business owner, sometimes their management team, sometimes their other advisors, their family, and we really talk through what's going on. And it's like a discovery process. And what we're trying to figure out is, what is their personal readiness to transition their business? What's their financial readiness to transition the business? What's the business readiness to transition so that they're going to get maximum value when they do leave the business? And we also work to give them a high level calc of value so they have some sort of indication of what their business is currently worth. And from there, we pull all that information together and we put together a report with findings and recommendations around those areas. And then we work with the business owner to build a plan, a roadmap to help them get everything organized. And the first thing we always do on the roadmap is make sure we're de-risking the business. So do they have an estate plan in place? Do they have disability insurance? Do they have life insurance? Is there a strong buy-sell in place? Do they have peace of mind that everything's going to be okay? So we always want to de-risk first, and then we move into the other areas. And that's where other team members come in. We have strong estate and tax planning folks. Maybe the business is solely reliant on the business owner, and we need them to step back so that we decentralize the owner from the business, right? So that it adds more value. So we have talent solutions people that can help them find someone to come in and take that leadership role burden from the owner. If they want to sell, we have an investment banking team that can help. We just have so many resources to wrap our arms around our clients to help them plan their transition.
So I love the team approach. Definitely sounds like you're quarterbacking a lot of that relationship. And it sounds like when you're getting involved here, there's definitely some technical aspects of that: financial planning, estate planning, tax. And then I also heard you talk about family dynamics and the emotional aspects of it. So maybe you could talk about just some of the observations that you've got as you've been on this journey about your prior work with family businesses, and just, are these issues fairly common, and are some of them also unique to the businesses that you work with? Because I'm sure that they just range the gamut.
All over the place, right? So, if we all just think of our own individual families, if someone was to come in and ask a few questions, they'd probably dig up some stuff that's going on with the family, right? And I think when I meet with families and the business owners, their main concern is they want their family to be okay. They might have a brother or sister where things went really bad and they're not talking anymore. They may have been part of a horrible transition and they don't want their family to come apart. And what often causes those tensions or issues with families is uncommunicated expectations. The parents just expect, of course, my kids want to take over my business, but it was the parents' passion. It's not necessarily the kids' passions, and they're scared to tell their parents that. So there's these unknown expectations, this communication that just never happens because they don't want to get into the tough issues that will bubble up if they don't get into them. A lot of times the families just has their head down working hard. So they haven't had the time to talk about it or to work through it. And there's just a lot of emotion, misunderstanding about personalities. Why does this kid grate on me? They're not working hard enough, or they work too hard. And it's really not understanding how we're uniquely hardwired and how we can leverage each other and carry each other and help each other versus, be annoyed and frustrated with each other. So there's just things that if we work through and we're honest about, can really help that transition be a celebration, right? The best day of our lives versus the worst day of our lives.
Yeah, so you unpacked a lot of different things there, Lisa. Some of them were that, people have their head down and they're working hard. And so I think because of that, this can be something that people put off. But you also have talked about all the layers and elements and considerations that go into this. And so it strikes me that this can be time consuming and there can be multifaceted things to be considered here. And so in light of that, how does a business owner know when is the right time to start working on that transition? And then how long does it usually take for somebody to be personally ready and even financially ready? And then even, just get that business ready to transition?
So ideally, people will say it takes 3 to 5 years. Here, we can just accelerate the process, but they might not get maximum value because a lot of the things is, my colleague Samantha Metcalf that I work with all the time, if you were to ask her that question, she said, now, like it's time to start now. No matter what your time frame is, you should always be thinking about it. What concerns me is when we go after one thing and we don't look at it holistically. So someone will say, I need evaluation, but there's so many, and yes, that's important, but there's so many other pieces. We do this every day. We help owners plan their transition, and it's a one-time thing they're going to do. So I highly recommend that any business owner surround themselves with a team of advisors who do this all the time, because this is a big deal transaction for you, potentially your family, your partners. Let's make sure we get it right the first time.
Yeah, I think that's right. And so you just talked about team and you quarterback a lot of this. Mike, I know you work a lot with Lisa. Can you share why it's important from your perspective, really, as to why the business owners should utilize a team when they're working through these transitions? Because I think even when you think about the individuals and trust side, there's a lot of issues just even packaged right there that you got to deal with.
Yeah, thanks, Leslie. And I think Lisa did a great job of articulating kind of and giving the audience a window into what is that like when we're working with a business owner. And I'll tell you, the experience is very different when a business owner has worked with Lisa and her team to walk through that piece before we start doing some of the estate and legacy planning. And the reason why that is oftentimes we'll hear from a client that'll call us and they'll say, well, I heard about this particular strategy. Maybe it was a spousal lifetime access trust, for example, and they'll call and say, I heard about this strategy. Is this right for me? And the answer is, it depends. It really depends on what the goals of that individual are. And if they've walked through that process that Lisa just described, then there's much more clarity around what's important to them, to their family, and they're not having to decide, does this tool necessarily fix a problem, when they don't really maybe understand all the dynamics of that problem or that issue. So I think having or going through that process, and then when you look at some of the financial issues, oftentimes business owners are asking that question of, well, how much do I need to sell my business for? And again, it depends on, that question around how much is enough is going to be different for each person. And what do they want that after-tax proceed number to really drive? What kind of lifestyle do they want to live? And having that clarity that comes with some of our wealth advisory team members that can speak to that and walk a client down that path of a personal financial plan is really invaluable in that process. Obviously, the tax implications of the sale of a business is really important, because it's really not how much you get, it's how much you get to keep. And so really important to understand, based on that transaction, what will be remaining after that tax liability. And then I think the last thing that gets brought to the forefront when we work in tandem like that is there's legacy goals and maybe philanthropic goals that can be incorporated into that planning that otherwise might be missed if there's not good clarity on what's important to that business owner. Then it's easy to maybe make assumptions that might be off, and then we'd have to correct through that process. So that's really why I think it's important to bring that whole team into that process.
I think those are all just great things that you highlighted there about the importance of teaming, in addition to what Lisa said. So kind of wrapping this up here, are there any takeaways from either of you that you'd like family business owners that are maybe watching this right now or later to reflect on based on experiences that you guys have had working with the business owners?
So Leslie, what I would recommend, whether you're a family business owner or just a business owner, really start planning early, right? Because you never know, when your exit may be. And I know that sounds kind of morbid, but we've seen a lot of families struggle in the aftermath if it wasn't all well planned out. So start planning early and surround yourself with a great team of advisors who've walked the path before and can help you navigate to help you have peace of mind and feel good that everything's going to be okay.
I think that's great advice. What about you, Mike?
Yeah, thanks, Leslie. I think kind of three things are top of mind for me. I think starting with that financial plan really serves as a roadmap. So I would encourage our listeners to do that if they haven't gone through that exercise. It's really valuable, the plan itself, but also some of the byproducts that come out of the discussions that happen through that process. I think from that, developing some scenarios and being equipped with, what happens if the business really is only worth this much, and I needed a different number in order to do those things that I want to do in my life, or some of the legacy goals I mentioned. So having those different scenarios really helps to bring clarity there. And then lastly, I would encourage our listeners, involve your family, because so many times, Lisa shared a great story the other day with a client where there was a great assumption being made by a business owner about his kids and their level of interest in the business that was likely off from what they really wanted. So I think the earlier you can involve your family in that process, the better.
That is also awesome advice. Thank you. We are getting near the end, but Mike, we do have one question that I do want to address because I think you've been talking so much about the changes for the year, and I think it'd be great if you addressed it. So somebody was asking, looking further out, do you think that it's likely that the estate and gift tax exemptions will actually be reduced by the Build Back Better or scheduled by a 2026 cut?
Yeah, thanks for that, Leslie. Maybe just quickly, the background from that question. I appreciate the question from someone in the audience. The estate tax exemption currently is about $12 million per person. That means that for a married couple, they could have an estate of $24 million that is taxed upon their passing and not be burdened with an estate tax. All of that could be exempt from tax. Well, in 2026, what's scheduled to happen is that exemption is scheduled to go from $12 million per person down to about $6 million per person if Congress does not do anything different in that interim time period. So that's really kind of the background of the question. Do I think that we'll see any change between now and 2026? I think it's unlikely at this point because of some of what we saw with Build Back Better and some of the headwinds that it faced. Now, that doesn't mean that that should cause some patience on doing some planning, because I have plenty of time to do that. Certainly, Congress could do that, and it could be a provision to raise some revenue in the future. But as I said, if Congress doesn't enact new legislation, that the current legislation will bring that exemption level down. So certainly a good reason to do some planning before you get to that point.
Well, thank you so much for bringing clarity to that. And it is unbelievable how fast that half hour went. So, unfortunately, that is all the time that we have for today. We want to thank Lisa and Mike so much for joining us and for their wonderful insights. And I do want to thank our moderators who have been with us and for all of your engagement and participation and questions. We love having you. We love having your questions. And we hope everybody has a wonderful weekend. We'll be back with you soon, but until then, stay safe and healthy. Thank you so much.